The global financial system is facing mounting pressure. Central banks are aggressively increasing their gold reserves. The US national debt has reached staggering levels, and geopolitical rifts are deepening economic instability. But what does all of this mean for investors? Legendary investor Jim Rogers has been sounding the alarm for years, and today we'll be exploring the unfolding crisis and its potential consequences, all with Jim's input.
Well, I can add and I can subtract. And I know that the debt is unbelievable in the U.S. I don't know how it's gotten so high because I think everybody can add, or nearly everybody. The debt numbers are so high in the U.S. For me, it's unfathomable. It's impossible that we will ever pay them off, and yet nobody does anything. Some people talk about it, but they don't do more than talk about it. The numbers do not work. You can never pay off the debt that the U.S. is running up, and they run it up more every month.
Yep, the US debt is a big deal that even Trump and Doge can't make go away. A critical shift occurred last year. For the first time in history, the US government allocated more funds to cover interest payments on its debt than for national defense. This trend has historically signaled the decline of global superpowers, raising the questions about the future of US economic dominance. Now, forecasts suggest that US debt could exceed 160% of GDP by mid-century, with $2 trillion in annual net treasury issuance projected over the next decade. And unlike past cycles, the usual buyers, such as the Federal Reserve and foreign governments, may no longer provide the same level of support. So officially this year, the US national debt is set to hit 100% of GDP, a staggering leap from just 36% in 2005. But whilst the Congressional Budget Office projects this debt will climb to 118% of GDP by 2035, other estimates, like those from Trading Economics, suggest we're already at 123% as of March this year, with projections of 126% by next year. That's right, debt is growing faster than GDP, and the deficit, currently at 1.9 trillion, is fueled by mandatory spending and interest payments that already outstrip government revenues. If nothing changes, federal debt will smash the post-World War II record by 2029, assuming no recessions, because those never happen, right? And by 2035, annual interest payments alone will balloon to 1.8 trillion, nearly double today's levels, and 1.7 times the entire US defense budget. So while the government paints a grim picture, the reality might be even bleaker. But hey, at least we're breaking records. So some argue that sovereign nations with control over their currency can simply print their way out of debt. However, history tells us a different story. Superpowers that have spent more on servicing their debt than on national defence, such as we saw with the British Empire, Habsburg Spain, and the Ottoman Empire, eventually lost their dominance. Could the US be heading down the same path?
Do I worry about it? Yes. In a word, yes.
As Jim says, this is a worry, a big, big worry. The deeper concern is the fragility of the global credit system. If borrowing costs continue to rise and economic confidence erodes, it could trigger liquidity issues, banking sector instability, and a cascading financial crisis. It's safe to say that a broader economic realignment is underway. Inflationary pressures remain unresolved. The return of aggressive trade tariffs, fragile supply chains, and shifting monetary policies have left businesses uncertain about the economic outlook. However, what makes this moment particularly precarious is the intensifying geopolitical realignment that we're seeing. The war in Ukraine has driven a wedge between global powers, with Western nations reinforcing economic and military alliances, while China and Russia deepen their cooperation. Economic sanctions, shifting supply chains, and realignments in trade agreements are accelerating a global reset that is reshaping economic relationships. Meanwhile, the vulnerability of the credit system is now on full display. Consumer debt is climbing, bankruptcies are increasing, and wage stagnation is leaving millions on the brink of financial distress. Many households are relying on credit just to maintain their standard of living, creating a precarious financial landscape. If the global economic order continues to fracture, nations may be forced to choose between aligning with Western-led financial systems or alternative networks, spearheaded by China and Russia, further exacerbating this economic volatility. The greatest risk lies in the possibility of credit markets freezing up. If lending slows and liquidity dries up, the economic engine just grinds to a halt, affecting everything from small businesses to global trade networks.
Now, I know that tariffs are not good for anybody, But it doesn't matter what I know. Mr. Trump has it in his mind, apparently, that Trump tariffs will be good for him, certainly good for him, and maybe even good for the country. So we will have more tariffs. But trade wars have never been good for anybody.
Tariffs, what a flip-flop they are turning out to be, but without doubt, they are here to stay, and they are adding another layer of instability to the global economy. The recent surge in protectionist policies from the US and those installed as a means of retaliation has shaken markets, disrupted supply chains, and raised concerns over rising consumer prices. Historically, trade wars have rarely yielded positive results, yet governments continue to pursue them, hoping for short-term political gains. The US has imposed sweeping tariffs on key trading partners, prompting retaliation across the globe, never mind some serious fighting talk from the likes of China and Canada. Now, this cycle of economic retaliation not only fuels uncertainty, but it also discourages investment and long-term economic planning. Economists warn that persistent trade barriers could accelerate deglobalization, pushing nations to develop independent supply chains and financial systems. This would weaken the dominance of the US dollar as more countries seek alternative trading mechanisms beyond Western controlled financial networks. For investors, the long-term impact of tariffs means higher costs, reduced corporate earnings, and increased volatility in stock markets. As the global economic system fractures, investors will need to diversify into assets that hold intrinsic value, like gold and silver. Central banks, as we know, have been making significant moves in the gold market. A wave of gold shipments from London to the US suggests this potential repositioning of reserves. Why are they doing this? Well, Jim doesn't buy the party line that it's all about tariffs.
I don't think many people are rushing out to buy gold for tariff reasons. They can read the same newspapers you and I can, and they know what's going on in the world. And they're also, I guess some of them know, I know that there will be money printing again when things get tough. The first thing the central banks will do is print more money.
While some attribute these shifts to logistical factors, others believe they point to a broader shift in the global financial structure. Rising military expenditures, mounting government deficits have created an environment where gold is increasingly viewed as a safe haven. Institutions are stockpiling bullion as insurance against economic instability. We can see from data, as we've previously reported, that US gold imports have surged, with Switzerland being a key supplier. Investors and institutions are clearly taking steps to mitigate exposure to potential currency fluctuations and systemic risks. For over a century, the US dollar has served as the backbone of the global financial system. From trade settlements to central bank reserves, its dominance has been unparalleled. However, history suggests that no reserve currency lasts forever.
We've had many reserve currencies, many international currencies throughout history. None of them have survived. I can remember 100 years ago, the pound sterling. There was no question. In 1925, the pound sterling was it. There was no number two. 50 years later, it was bankrupt. IMF had to fly to London to bail out the British government to help them pay their bills. That was a currency that at previous 50 years before had been, nobody even bothered to question it. It was so strong and solid and powerful in the world's financial system. But this has happened to other currencies. And I can, as I say, I can add. I know that the numbers in the US cannot work. Just absolutely cannot work, physically cannot work.
A century ago, the British pound was the world's preeminent reserve currency. It was unchallenged until it wasn't. A combination of war, debt, economic mismanagement, and the rise of stronger competitors has led to its decline. 50 years later, the IMF had to bail out the British government. And today, the US is very close to finding itself in a similar predicament. The cracks in the US dollar's dominance are becoming more and more evident. Nations once reliant on that greenback are diversifying their reserves. Central banks are accelerating their gold purchases, with China and Russia leading the way. And at the same time, efforts to de-dollarize trade are really gaining momentum. From oil transactions in yuan to new digital payment systems that bypass US financial infrastructure, the global financial order is shifting. The question is not whether the US dollar will lose its dominance. It's how quickly the transition will unfold. If confidence in the dollar erodes too rapidly, markets could be thrown into chaos. However, a gradual decline, similar to what happened with the British pound, would allow for a more orderly transition to a more multipolar financial system. For investors, this moment demands preparation. Gold, historically an anchor of stability during monetary transitions, continues to be accumulated by central banks and institutional players. And those who fail to recognize these shifts risk being caught off guard.
People see war and money printing, potential lots of money printing. And in times like that, they buy gold and silver because they know all that throughout history, gold and silver will protect you. They always have.
So what's the most critical lesson here? Preparation is key. Nations and institutions are taking proactive steps to safeguard their financial stability, whether through gold acquisitions, diversifying reserve holdings, or developing alternative economic systems. The traditional financial system, particularly the credit markets, is under strain. With debt burdens rising and lending becoming riskier, the probability of systemic disruptions continues to grow. And what do you need to do? Well, investors must assess how best to protect their wealth in this ever-evolving landscape. Hard assets like gold and silver have historically played a vital role during times of financial uncertainty. But what do you think? Let us know in the comments below, hit subscribe, and let's keep the conversation going.